Good morning, good afternoon, and good evening. Today we will talk about Chapter 14, Part 1. After half of the journey, are you confident enough for the investment planning? What kind of mentalities do you need to ace the current market? Today we will discuss about it. Cheers! A life cycle guide to investing. There are 2 times in a man's life when he should not speculate: when he can't afford it, and when he can. Mark Twain, Following the Equator. Investment strategy needs to be key to one's life cycle. A 34-year-old and a 68-year-old saving for retirement should use different financial instruments to accomplish their goals. The 34-year-old just beginning to enter the peak years of salaried earnings can use wages to cover any losses from increased risk. The 68-year-old likely to depend on investment income to supplement or replace salary income cannot risk incurring losses. Even the same financial instrument can mean different things to different people depending on their capacity for risk. Although the 34-year-old and the 68-year-old may both invest in a certificate of deposit, the younger may do so because of an attitudinal aversion to risk and the older because of a reduced capacity to accept risk. In the first case, one has more choice in how much risk to assume. In the second, one does not. The most important investment decision you will probably ever make concerns the balancing of asset categories, stocks, bonds, real estate, money market securities, and so on, at different stages of your life. According to Roger Ibbotson, who has spent a lifetime measuring returns from alternative portfolios, more than 90% of an investor's total return is determined by the asset categories that are selected and their overall proportional representation. Less than 10% of investment success is determined by the specific stocks or mutual funds that an individual chooses. In this chapter, I will show you that whatever your aversion to risk, whatever your position on the eat well, sleep well scale, your age, income from employment, and specific responsibilities in life go a long way toward helping you determine the mix of assets in your portfolio. 5 asset allocation principles. Before we can determine a rational basis for making asset allocation decisions, certain principles must be kept firmly in mind. We've covered some of them implicitly in earlier chapters, but treating them explicitly here should prove very helpful. The key principles are: 1. History shows that risk and return are related. 2. The risk of investing in common stocks and bonds depends on the length of time the investments are held. The longer an investor's holding period, the lower the likely variation in the asset's return. 3. Dollar cost averaging can be a useful, though controversial, technique to reduce the risk of stock and bond investment. 4. Rebalancing can reduce risk and, in some circumstances, increase investment returns. 5. You must distinguish between your attitude toward and your capacity for risk. The risks you can afford to take depend on your total financial situation, including the types and sources of your income exclusive of investment income. 1. Risk and reward are related. Although you may be tired of hearing that investment rewards can be increased only by the assumption of greater risk, no lesson is more important in investment management. This fundamental law of finance is supported by centuries of historical data. The table below, summarizing the Ibbotson data presented earlier, illustrates the point. Total annual returns for basic asset classes, 1926 to 2013 average annual return risk index, year-to-year volatility of returns, small company common stocks 12.3%, 32.3%, large company common stocks 10.1, 20.2, long-term government bonds 6.08, 0.4, U.S. Treasury bills 3.5, 3.1. Source: Ibbotson Associates. Common stocks have clearly provided very generous long-run rates of return. Common stocks have clearly provided very generous long-run rates of return. It has been estimated that if George Washington had put just $1 aside from his first presidential salary and invested it in common stocks, his heirs would have been millionaires more than 10 times over by 2014. Roger Ibbotson estimates that stocks have provided a compounded rate of return of more than 8% per year since 1790. As the table above shows, returns have been even more generous since 1926, when common stocks of large companies earned about 10%. But this return came only at substantial risk to investors. Total returns were negative in about 3 years out of 10. So as you reach for higher returns, never forget the saying. There ain't no such thing as a free lunch. Higher risk is the price one pays for more generous returns. 2. Your actual risk in stock and bond investing depends on the length of time you hold your investment. Your staying power, the length of time you hold on to your investment, plays a critical role in the actual risk you assume from any investment decision. Thus, your stage in the life cycle is a critical element in determining the allocation of your assets. Let's see why the length of your holding period is so important in determining your capacity for risk. We saw in the preceding table that long-term government bonds have provided an average 6% annual rate of return over an 83-year period. The risk index, however, showed that in any single year this rate could stray far from the yearly average. Indeed, in many individual years, it was actually negative. Early in the first decade of the 2000s, you could invest in a 5.25% 20-year U.S. Treasury bond, and if you held it for exactly 20 years you would earn exactly 5.25%. The rub is that if you found that you had to sell it a year later, your rate of return could be 20%, 0%, or even a substantial loss if interest rates rose sharply, with existing bond prices falling to adjust to the new higher interest rates. I think you can see why your age and the likelihood that you can stay with your investment program can determine the amount of risk involved in any specific investment program. What about investing in common stocks? Could it be that the risk of investing in stocks also decreases with the length of time they are held? The answer is a qualified yes. A substantial amount, but not all, of the risk of common stock investment can be eliminated by adopting a program of long-term ownership and sticking to it through thick and thin, the buy and hold strategy discussed in earlier chapters. The figure on page 353 is worth 1,000 words, so I can be brief in my explanation. Note that if you held a diversified stock portfolio, such as the Standard & Poor's 500 stock index, during the period from 1950 through 2013, you would have earned, on average, a quite generous return of about 10%. But the range of outcomes is certainly far too wide for an investor who has trouble sleeping at night. In 1 year, the rate of return from a typical stock portfolio was more than 52%, whereas in another year it was negative by 37%. Clearly, there is no dependability of earning an adequate rate of return in any single year. A 1-year U.S. Treasury security or a 1-year government-guaranteed certificate of deposit is the investment for those who need the money next year. But note how the picture changes if you hold on to your common stock investments for 25 years. Although there is some variability in the return achieved, depending on the exact 25-year period in question, that variability is not large. On average, investments over all 25-year periods covered by this figure have produced a rate of return of slightly more than 10%. This long-run expected rate of return was reduced by less than 3 percentage points if you happened to invest during the worst 25-year period since 1950. It is this fundamental truth that makes a life cycle view of investing so important. The longer the time period over which you can hold on to your investments, the greater should be the share of common stocks in your portfolio. In general, you are reasonably sure of earning the generous rates of return available from common stocks only if you can hold them for relatively long periods of time. Over investment periods of 20 or 30 years, stocks have generally been the clear winners, as is shown in the table below. These data further support the advice that younger people should have a larger proportion of their assets in stocks than older people. Probability that stocks outperform bonds, percentage of periods since 1802 when returns of stocks exceed the return from bonds. Investment period percentage of periods when stocks have outperformed bonds: 1 year 60.2, 2 years 64.7, 5 years 69.5, 10 years 79.7, 20 years 91.3, 30 years 99.4. I do not mean to argue that stocks are not risky over long holding periods. Certainly the variability of the final value of your portfolio does increase the longer you hold your stocks. And we know that investors have experienced decades during which common stocks have produced near zero overall returns. But for investors whose holding periods can be measured in 25 years or more, and especially those who reinvest their dividends and even add to their holdings through dollar cost averaging, common stocks are very likely to provide higher returns than are available from safe bonds and even safer government-guaranteed savings accounts. Finally, perhaps the most important reason for investors to become more conservative with age is that they have fewer years of paid labor ahead of them. Thus, they cannot count on salary income to sustain them if the stock market has a period of negative returns. Reverses in the stock market could then directly affect an individual's standard of living, and the steadier, even if smaller, returns from bonds represent the more prudent investment stance. Hence, stocks should make up a smaller proportion of their assets. 3. Dollar cost averaging can reduce the risks of investing in stocks and bonds if, like most people, you will be building up your investment portfolio slowly over time with the accretion of yearly savings. You will be taking advantage of dollar cost averaging. This technique is controversial, but it does help you avoid dollar cost averaging. But it does help you avoid the risk of putting all your money in the stock or bond market at the wrong time. Don't be alarmed by the fancy-sounding name. Dollar cost averaging simply means investing the same fixed amount of money in, for example, the shares of some index mutual fund, at regular intervals, say, every month or quarter over a long period of time. Periodic investments of equal dollar amounts in common stocks can reduce, but not avoid, the risks of equity investment by ensuring that the entire portfolio of stocks will not be purchased at temporarily inflated prices. The table on page 356 assumes that $1,000 is invested each year. In scenario 1, the market falls immediately after the investment program begins. Then it rises sharply and finally falls again, ending, in year 5, exactly where it began. In scenario 2, the market rises continuously and ends up 40% higher. While exactly $5,000 is invested in both cases, the investor in the volatile market ends up with $6,048, a nice return of $1,048, even though the stock market ended exactly where it started. In the scenario where the market rose each year and ended up 40% from where it began, the investor's final stake is only $5,915. Warren Buffett presents a lucid rationale for this investment principle. In one of his published essays he says, "A short quiz: if you plan to eat hamburgers throughout your life and are not a cattle producer, should you wish for higher or lower prices for beef? Likewise, if you are going to buy a car from time to time but are not an auto manufacturer, should you prefer higher or lower car prices?" These questions, of course, answer themselves. But now for the final exam. If you expect to be a net saver during the next 5 years, should you hope for a higher or lower stock market during that period? Many investors get this one wrong. Even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. In effect, they rejoice because prices have risen for the hamburgers they will soon be buying. This reaction makes no sense. Only those who will be sellers of equities in the near future should be happy at seeing stocks rise. Prospective purchasers should much prefer sinking prices. Dollar cost averaging is not a panacea that eliminates the risk of investing in common stocks. It will not save your 401k plan from a devastating fall in value during a year such as 2008, because no plan can protect you from a punishing bear market. And you must have both the cash and the confidence to continue making the periodic investments even when the sky is the darkest. No matter how scary the financial news, no matter how difficult it is to see any signs of optimism, you must not interrupt the automatic pilot nature of the program. Because if you do, you will lose the benefit of buying at least some of your shares after a sharp market decline when they are for sale at low prices. Dollar cost averaging will give you this bargain. Your average price per share will be lower than the average price at which you bought shares. Why? Because you'll buy more shares at low prices and fewer at high prices. Some investment advisors are not fans of dollar cost averaging, because the strategy is not optimal if the market does go straight up. You would have been better off putting all $5,000 into the market at the beginning of the period. But it does provide a reasonable insurance policy against poor future stock markets. And it does minimize the regret that inevitably follows if you were unlucky enough to have put all your money into the stock market during a peak period such as March of 2000 or October of 2007. To further illustrate the benefits of dollar cost averaging, let's move from a hypothetical to a real example. The following table shows the results, ignoring taxes, of a $500 initial investment made on January 1, 1978, and thereafter $100 per month, in the shares of the Vanguard 500 Index Mutual Fund. Less than $44,000 was committed to the program. The final value was over $480,000. Of course, no one can be sure that the next 45 years will provide the same returns as past periods. But the table does illustrate the tremendous potential gains possible from consistently following a dollar cost averaging program. But remember, because there is a long-term uptrend in common stock prices, this technique is not necessarily appropriate if you need to invest a lump sum such as a bequest. If possible, keep a small reserve in a money fund to take advantage of market declines and buy a few extra shares if the market is down sharply. I'm not suggesting for a minute that you try to forecast the market. However, it's usually a good time to buy after the market has fallen out of bed. Just as hope and greed can sometimes feed on themselves to produce speculative bubbles, so do pessimism and despair react to produce market panics. The greatest market panics are just as unfounded as the most pathological speculative explosions. For the stock market as a whole, not for individual stocks, Newton's law has always worked in reverse. What goes down has come back up. 4. Rebalancing can reduce investment risk and possibly increase returns. A very simple investment technique called rebalancing can reduce investment risk and, in some circumstances, even increase investment returns. The technique simply involves bringing the proportions of your assets devoted to different asset classes, example, stocks and bonds, back into the proportions suited to your age and your attitude toward and capacity for risk. Suppose you decided that your portfolio ought to consist of 60% stocks and 40% bonds, and at the start of your investment program you divided your funds in those proportions between those two asset classes. But after 1 year you discovered that your stocks had risen sharply while the bonds had fallen in price, so the portfolio was now 70% stocks and 30% bonds. A 70-30 mix would then appear to be a riskier allocation than the one most suitable for your risk tolerance. The rebalancing technique calls for selling some stocks, or equity mutual funds, and buying bonds to bring the allocation back to 60-40. The table below shows the results of a rebalancing strategy over the 20 years ending in December 2013. Every year, no more than once a year, the asset mix was brought back to the 60-40 initial allocation. Investments were made in low-cost index funds. The table shows that the volatility of the market value of the portfolio was markedly reduced by the rebalancing strategy. Moreover, rebalancing improved the average annual portfolio return. Without rebalancing, the portfolio returned 8.14% over the period. Rebalancing improved the annual rate of return to 8.41% with less volatility. The importance of rebalancing, January 1996 to December 2013. During this period, an annually rebalanced portfolio provided lower volatility and higher return. Average annual return risk asterisk, volatility, 60% Russell 3000/40% Barclays aggregate bond, annually rebalanced 8.41 11.55 60% Russell 3000/40% Barclays aggregate bond, never rebalanced 8.14 13.26 asterisk standard deviation of return. Stocks represented by a Russell 3000 total stock market fund. Bonds represented by a Barclays aggregate total bond market fund. Taxes not considered. What kind of alchemy permitted the investor who followed a rebalancing strategy at the end of each year to increase her rate of return? Think back to what was happening to the stock market over this period. By late 1999, the stock market had experienced an unprecedented bubble and equity values soared. The investor who rebalanced had no idea that the top of the market was near, but she did see that the equity portion of the portfolio had soared far above her 60% target. Thus, she sold enough equities and bought enough bonds to restore the original mix. Then, in late 2002, at just about the bottom of the bear market for stocks, and after a strong positive market for bonds, she found that the equity share was well below 60% and the bond share was well above 40%, and she rebalanced into stocks. Again, at the end of 2008, when stocks had plummeted and bonds had risen, she sold bonds and bought stocks. We all wish that we had a little genie who could reliably tell us to buy low and sell high. Systematic rebalancing is the closest analog we have.